Are the market winners looking a little overextended? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Thomas Thornton, founder of Hedge Fund Telemetry. Hey, Tommy, welcome to the Market House.
Hey, Maggie, I'm happy to be in the house.
Happy to be in the house. We're happy to have you. I love when people say that. And hey to everybody who's joining us on Substack and YouTube Live. It's great to see you all. As usual, drop those questions in the chats, and we will get to as many as we can. And it's so fun to have Tommy here to answer them, since we know he's a great shooter. So hey, let's start with the markets, Tommy, because we had NASDAQ hit a new record high today. Gold did as well. Bond yields dropped as well. I mean, can all of these markets rally in tandem, or what do you make of this market action?
I think we're stretched, and I could have said that a couple months ago, and I've been wrong in the sense that I didn't expect the S&P to lift as much as it has, and it's narrowed a bit. So that's one aspect of it. But I caught the moves in April pretty well. Overhedged myself. I'm still doing pretty well this year. Almost double the S&P return, which we're nobody. I'm not complaining, but it certainly is a stretched market, and you have a lot of things coming up right now. I think that the Fed has made their bet, and they're going to say, hey, we're going to attempt to control the labor market, and that to me is a challenge, because then you have a inflation issue with tariffs, which I don't think have really filtered into the system, and is certainly not into the data yet. And we have the CPI, and we have the PPI first, and then CPI, and I think that it's going to show a rise in inflation if the regional surveys are any tell. And I think that that's just going to continue a bit higher. I don't see this, tremendous spike in inflation. It's not the 1970s, but I think you're going to have a stagflationary type of an environment, which in many respects is the worst case for the Fed. So they're going after the labor market, and historically, when the labor market starts to weaken, it's not a 1 quarter or 2 quarter, we'll cut rates 50 basis points and boom, we're all back, and it's, we've made America great again. I think that it's going to take possibly a year and many cuts, and probably you'll see the Fed funds rate get down to 1%. Now, the problem that people are going to have to deal with, and I think we can look back a year when the Fed cut rates, the Treasury market didn't go along. And now the Treasury market ahead of the Fed cutting started to rally, and rates moved lower, and it was game on, and everybody was excited. But I think there's fiscal imbalances that are happening in the US right now. You have a huge deficit. You have an out of control US debt level at 37 trillion, and interest payments are becoming a real thing, bigger than some of the other entitlements and defense spending, and that I think is going to add up. And as Scott Bessent said, we're on the warning track, but we're not at that breaking point yet. I think that eventually we'll have to deal with that, and I think other countries are dealing with that right now. France, notably today, lost their prime minister, voted out, no confidence, and they're really struggling, and they didn't even have the debt load that we have. But with interest rates high and moving higher globally, I think this is going to be an issue that will affect the markets. Now, equity markets, look, you have 10% 10 stocks equal 40% of the S&P. We all know passive inflows have been coming in. Retail's super active, and they're concentrated in these big tech names: Nvidia, Palantir, Tesla, Microsoft. You might as well just name all the Mag 7, and they're concentrated there. And I think that creates an imbalance that eventually is going to become an issue. It could become a bigger issue real soon. And I think that with the equity markets that have gone up basically uncorrected for as long as they have. I mean, we haven't seen really any sort of correction for more than a few days or a few weeks, just sideways. I think that creates a risk of complacency that could become something a little bigger and a little bit more severe.
So I want to follow up on a bunch in there, but that last part, why does the lack of correction, in what way is it hitting sentiment that worries you? Talk to me a little bit more about that.
Well, you can look at a lot of different, measures. I track on our site. We track the daily sentiment index data, and that's daily, and that's elevated right now. It's not extreme because we have actually the extreme levels were reached back in July, so we actually have a little bit of a negative divergence. You can look at the VIX at a low level. You can look at credit spreads. The CDX high yield and investment grade both have to mark exhaustion signals. The VIX had one late last week. The SPY is about a day or two away from a new one, and the QQQ NDX had one on Friday. Now we've had several on the way up, and we've had these moderate pullbacks or stalling periods, and that's essentially what these indicators do. They exhaust the buyers on the way up, and that some people expect 1987 to happen hours after the signal, but sometimes it's just a matter of the buyers just running out of some bullets until they can reload, or it could be something a little bit more. But when you have all these things lining up and you have really just basic complacency, you still have huge option buying and short-term options. You have put call ratios are pretty low, which essentially I like to buy, and I did in April when everybody's buying puts, and it's like buying insurance on your house when it's on fire, or there's a hurricane that's about 10 minutes away. It's too late. So I think right now is a good time to hedge, and not a lot of people are, in my view and what I've seen, are taking advantage of the low volatility to hedge. You also have option selling strategies, the vol control strategies, with huge assets right now, and CTAs are fully positioned long, 100% percentile according to Goldman Sachs. That just equals up to who's left to buy and why, because valuations are high. You have an S&P trading at a historical high multiple. Some people say, oh, it's not that bad. But if you look at certain stocks, you look at a Tesla trading at 200 times, you look at a Broadcom trading at 50 times earnings, you look at NVIDIA trading at 40 times earnings, Palantir, I mean, it's just off the charts. It's been a lot of multiple expansion, and you really do need more earnings growth. And Goldman said today in one of their strategy notes that they expect 6% growth. Now, 6% growth after all this multiple expansion, something's got to give here. And I think that again, I think that just shows that people are fairly complacent.
Yeah. Some folks in the chat agree with you. D-Roy said, felt like this in Feb 2000, awaiting the Wile E. Coyote moment, perhaps with a Fed rate cut. And
Yeah.
Alan brought up a really good point, that I think it was Alan, that passive investment ruins price discovery mechanism. And so when you've just got this sort of steady flow in, people
Yeah.
are not really, doing the kind of math you're talking about. What do you make of the fact? Do you feel like it's retail driving this? I mean, there was a lot of discussion around in April when institutional money got very concerned. There was a lot of talk of this rotation away from the U.S., people pulling their money out of the U.S., a lot of people banging the drum it was time for the rest of the world, and retail stepped in and bought like crazy, and they were greatly rewarded for that. Do you feel like it's retail driving this? Is it a mix? Why are we seeing this, this melt up, as people describe it?
Right. I think retail has a lot to do with it, and they've been right. And congrats to them. It's just I've seen times in my 3 decades of doing this crazy business, that retail stays at the table too long and they play one more hand and it bites them. And I think that, I mean, today on Bloomberg, there was a story about Gen Z. The people are quitting their jobs because they're chasing 90% yields. Now, I think that right there, it kind of reminded me of in 2099, where people were quitting their jobs to go work at day trading firms where you were given leverage to go and trade stocks and get a percentage of it, and people were quitting their jobs and trading online because you could. And I think that it's similar to that people might just stay too late at the table and they're buying things that don't make any sense, or dollars. Things like some of these crypto treasury stocks that just come out of nowhere, and there was one up like crazy today. And people just buy these things. They have no idea the risk they're taking, and their whole thought is that they're going to buy it at this X price and hopefully make money and go out higher. But that party ends. And I'm not, look, I'm not necessarily a perma bear, because when I do get long, it's usually when people are fearful and scared out of their mind. And again, in April, you mentioned the flows. I mean, hedge funds were shorting like crazy, and that was part of the whole process that I put together of why I got long. And even on Twitter, I was saying to people I was getting long, and then good luck, and all that. Now it's kind of the same thing. If I say I'm net short, good luck. And you've had these huge moves, so you should have some reflexivity. And I think that is kind of the next step. And I try to stay fairly flexible, but I stay within a process that I've developed, and it seems to work.
Yeah, I mean, we talk about this all the time, cannot underscore and emphasize this enough, that having that framework and process is so important. We just talked to Dale about that. I know you and Dale talked recently. But all of you have been in this business for a really long time, are sort of laying the groundwork for what some people need to do. Fair enough, it's hard to do on your own sometimes. But if you can't do it on your own, talk to your financial advisor. And if you are going to try to figure it out, lots of the friends of show we have some great options, especially if you're trying to figure out options, which I know can be tricky. We'll drop some stuff in notes on Substack to sort of help guide you if you're trying to look for that. I want to ask a great question from someone on Substack, Ferret Labs. If equities de-risk, do we see metals de-risk too, or will it be viewed as a safe haven? I think this is a question that's on a lot of people's minds, Tommy.
Right. I'm sort of agnostic when it comes to the metals, and I've traded them, I trade them long and short, and I don't have any position right now in gold, and I think sentiment has got a bit excessive. Could probably go a little bit more, but one thing that you're going to see is you're going to see a lot of people that come on videos and CNBC and Bloomberg, and we like gold, we like gold, and it's already, it's up a X amount. Is the risk reward at buying today as good as it was when you bought it? And that's the difference between a lot of people like myself, who I'm on buy side. I'm from the hedge fund world, and then there's people that were broker side and the buy side, and they're fine reiterating what's already been working. And I think I came on this show in March with you, and I said I like uranium, and oh my God, the scorn I had was just awful. And that, those trades went up 60%. And, sometimes you have to be the type of investor that you're planting a seed in the ground rather than picking the fruit off the tree late. That's the thing. And that's, I think, the difference between some of the people that are out there talking about, they're talking their book.
They are, and you have to remember that.
But going back to your question on that, one thing that's happened in the past is that people rush to these safe haven assets, and market sentiment in gold and things like metals, they get overextended, and you have a lot of new people that come into these trades, and the inflows into GLD have been higher, like triple what SPY. And that to me poses a little bit of a risk because you have a lot of new people coming in. And so let's say things sell off in gold. Those people are going to be a little quicker to sell. The long term, the Peter Schiff people that are long gold forever and they'll die with it, no matter what, they're not selling. But you have to have new people come in to push prices higher. And some of those people are a little too short termish. But again, one problem that happens in market corrections, and if it's a severe one, everything goes down except cash, and that I think is the worst case scenario. If you go back to other periods, gold was sold, and I remember Ned Davis, the famous strategist, Ned Davis Group. He was in our office one time, and he's like, be careful because everybody's going to have to sell something, and even the best things that they own, they may have to sell for the liquidity aspect. And people are levered right now in this market, and it may not be the traditional leverage that people sometimes think, but they may be over levered in single name ETFs that are nuts, and some of the more speculative stuff out there. They may be levered in options, and that I think causes some concern. So it's possible you could have metals sell off as well. They could go a little bit more. And I on my weekly, I said that I thought gold had a little bit more upside. And I'm not necessarily buying it here, but I'm just saying that if you're long, could go a bit more.
Yeah, this is where time frame really matters, right? Because you're talking from a shorter trading perspective. And there is a different conversation. Julian's in the chat, I think, and we had it with him about sort of, what percentage of your portfolio and exposure in a little bit longer time period would you be thinking about? And, how are you fitting hard assets into that? Rafa just said, yes, but are they the marginal price setters in gold these days? I think he's referencing the fact that are we seeing central banks look to gold as an alternative, right? That's a sort of medium to longer term conversation. If I understand you right, you're looking at it from more of a trading perspective, correct?
I think right now, I think the latest buyer in gold has been the retail buyer, some institutions, but that's just my view while looking at the flows in GLD. When you have $3 billion flow into GLD after the big move, after all the crazy news that we have, which seems constant, which doesn't make anybody's life easier. But I think that's kind of the short-termism that I see with some people becoming touristy in gold right now.
So we were just talking about the Fed and the challenges facing them, the fact they're going to focus on the labor market. It sounds like you think we're at the beginning of a rate cut cycle. What do you see happening to rates? Just to be clear, do you think that they're going to follow suit, or is there a risk that the rate cuts actually cause a spike in yields, much like we saw when the Fed got aggressive last year?
I think there's the possibility that you could have a rate spike, and it may not necessarily become just because of the US only. It could be global rates lifting from Japan. I mean, Europe, you're seeing, some of the London, the UK, seeing rates spike on gilts. I think that if that starts to happen globally, it could affect US rates as well, because rates go up, you have bond sellers. And again, it's that liquidity. If you're selling one bond, you may be selling other bonds to de-risk your portfolio, even if you're selling the bond that you really want to keep, which I think is the US Treasury. But that I think is a potential. Again, I think there's fiscal imbalances, and if Trump takes over the monetary process with appointees, and the Fed it's always been political. It's just the fact, because a president who's in power appoints who he likes, and obviously they're going to have a correlating opinion of how monetary policy should be. Again, I think that the best thing the president could do is put the fiscal house in order, but I don't see that happening. I thought we were going to get some sort of spending cuts, and that was not quite there. And I don't think tariffs are going to be the result or a long-term benefit as some think. I think tariffs are a tax, and I think it's going to hit the consumer. It's going to hit profit margins with companies, and we're already seeing that. We're already seeing companies that reported, like Caterpillar, and said, "Oh, our earnings are going to be fine," and then like 2 weeks later, after earnings, "Oh, well, we see a 1.8 billion, or 180 billion dollars. I don't know what it was, just like a 1.8 billion in tariff costs this next quarter." So I think that you're going to see that. Walmart said that they're going to have to raise prices. They're eating part of the tariff, but they have thin margins, so there's a risk.
So we have a question on Substack from Konstantinos. What's your take on longer dated treasuries like TLT? Sounds like that's where the pain would be, right? As opposed to the short end, or
You're probably going to see a steepening of the curve, and that's when the two-year yield drops and the 30-year increases. And that, I don't necessarily think that is a great thing, because when we've seen that in the past, we've seen recessions happen. And if we have inflation in there as well because of tariffs, and that again is an external thing, it's not necessarily just, maybe it's a one-time thing like the Fed hopes, but it's still going to raise prices. And I think that's going to be difficult. It's hard because the president thinks that if the Fed cuts rates, the Treasury curve, all rates will go down. Housing will rebound. I don't see that happening, because if you lower rates, house prices already elevated will probably rise, because if you make borrowing easy, the price of whatever you're buying goes up. So that's just the basics.
yeah. Do you buy into at all the idea that the Trump administration is looking for a way to grow the US out of this problem?
Yeah,
Are we underestimating maybe their ability to do that?
yeah, I find that to be possible, but probably overly optimistic.
Fair enough. So you mentioned you're net short, right? So are you is it sort of concentrated in certain areas? Is this sort of like, I think Mag 7 or the big cap tech is really overextended, or is it scattered around based on what you see company by company?
I do have some Mag 7 names. I'm short. I just recently shorted Nvidia, Palantir. I still am short Tesla, Avago, Apple. Some of them are profitable, some aren't. Currently not too far off of where I see things. Yeah, I think partly because I think they're crowded, and I think that if people are going to hit the sell button, they're probably going to go for some of those. And the valuations are just elevated. I've got DeMark signals on a bunch of different things. Nvidia, Tesla has a sequential 13 today. Avago trade again. I think these are crowded, overly optimistic, and I think they'll come down. And if they go up, I'll cover them. I'll be wrong, and occasionally I'm wrong.
I think a lot of folks are maybe agree with you on the Tesla call. We had a poll in the chat. Would you buy Tesla at these levels? And 90% of the respondents said no. So a small sample, but obviously you have some folks who agree with you here. Boris has a
Yeah.
great question. He says, Tommy, great to see you. My question, where is the place to hide in your scenario?
It really depends on the circumstance as far as how hard the markets do go down. We could be in for 5 to 10% type correction. The buy the dip people have been buying pretty quick. I mean, they buy 1% down. It's like, oh my God, it's what a great buy. So if the scenario is, and it's usually, this is the way all corrections happen. You get a initial move down, then you get a bounce. The bounce fails, breaks the initial low, the first move, and then things get trickier because then more sellers show up. I think that hiding. Look, the first thing you do is, instead of like trying to find a different idea, sell some things down, move to cash. That's just basic 101 simplicity. Don't overly hedge yourself and get too complex or buy options. Just take some gains if you have them. It's not that hard to do. You can always buy it back, and that is what I would do. And a real good risk off scenario, if you want rates to come down, is an equity market correction. Again, in the beginning of the year, Trump wasn't looking at the markets, but he did cave pretty quick with the taco, and he didn't like the pain in market sentiment at 4,800. And that, if you really wanted to do something right and create like a bit of a recession, and I know everybody's like, oh my God, a recession, create some sort of washout, and it's sort of cleansing, and rates would come down naturally. That's more important. I know I think a lot of people have talked about yield curve control, and that's a whole nother, that's like over hedging yourself and creating another problem down the road. And you can ask Japan about that. So hiding cash, obviously, that's first off. Take gains.
Is there a sector that you like, or something you feel is out of favor that you're kind of thinking about, even if you don't have it on your books right now?
I started buying a few natural gas ideas, and I think natural gas, the commodity, is pretty washed out, and it's really unbelievably, it's abundant, obviously, for the price to be this low, but I think it's really essential going forward. And I just recently started to buy some natural gas ideas. I have been a long buyer of a company called Golar, which is a floating vessel natural gas extraction company, and they're leasing out vessels for 20 years, and the valuation is just incredible. And there's a lot of real smart people that I know that are involved in this one, and it's been a big winner for me. But it pulled back today on some Argentina news. I think it's a buy here at around $40. I think the stock will be 60 sometime early in 2026.
Of course, this isn't financial advice, people. Tommy's just nice enough to share his strategic thinking around these things, which we appreciate. You have to do your own due diligence because everyone has their own risk. But Braden is asking, would long equal weight S&P short Mag 7 ETF be a reasonable place to be as a pair trade under your scenario? Very specific question, Braden, but a good one.
Yeah, that trade hasn't worked, obviously. Again, it'll probably work, but if I go back and a lot of people say, well, small caps outperform the S&P and NASDAQ, 2000 to 2002. But the problem was that they still went down. They just went down less than the S&P. So from a relative trade, that probably will work. But the problem is you got to really break the passive fund flow investment crowded trade, and that's going to be tricky. And so I think it'll work, but it's going to really have to have a major turn and some fiscal responsibility to have lower rates, because I think lower rates are needed more in the 493 than in the Mag 7.
Biz Martinez has a great question. How can retail get into natural gas? Which companies are best to express that, or what's the best way to express that? That's a really good question. It always comes up when we're talking about commodities, but particularly energy.
Well, there's UNG, which is an ETN, like an ETF, but it's futures based. And one of the problems with that ETF is that you can't really hold that long term. It's more of a trading vehicle, and I'm long it right now, and I bought it a little lower. But it's more, in my view, a short-term type thing because there's a role with the futures, the way it's constructed. So each day, not to get geeky and or Greeky, I should say, but there's a theta roll-off that it loses a penny or two every day with the futures roll, and that's just to try and be as simple as possible. I try and buy the better natural gas. I'm long range resources right now. I'll just give you one. And again, I like Golar, which is a global type company that's more infrastructure, but it has a natural gas component as well. So those are two I like a lot.
Perfect. George Noble's in the chat. Hey, George. Restaurants look like a disaster. You've been short and correct. Still negative?
Yeah, I think that right now that, one of my things that the research I do, I've tracked a lot of consumer trends, and consumers have been trying to pull back on certain places. So I'm short Wingstop. I have actually decent gain there. I'm sort of even on McDonald's short. They're moving towards value meals. I'm short DoorDash, which is sort of the company that delivers all this stuff. And if people are getting a little, the consumer's getting a bit conscious of how much they're spending, they may just walk down the block or drive and pick up their food or cook from home, God forbid. I know. I like cooking from home.
So do I.
My wife's a great cook, so I'm spoiled in that regard. But I will say I used DoorDash at my old office for a couple years, and I would order like the dumb same salad every day from Chopped, and I was spending like $25 a day, and I just said, okay, I'm bringing in my own food, or I'm not going to eat lunch, diet, all sorts, and the amount of money you can save if you just add it up is actually pretty substantial. So I'm kind of frugal, otherwise known as cheap. So I just think that people are going to start to cut costs and look to better value when it comes to food, not necessarily better quality, but better value.
That's amazing. Frugal just makes it sound so much smarter than cheap, Tommy. There's some thought involved with that. So I'm going to go with frugal as well. And I agree. It's much healthier to make your own food as well. I do it all the time. Although I keep trying to resign from that job in my house, or at least job share it. But I don't have any takers at the moment. One more quick question. Any EM stocks? Braden's asking. We didn't talk about that and get to the dollar. Can't talk about everything, but are you also looking internationally, Tommy, or?
No, I'm not. Actually, I've had a really good call on Alibaba over the last couple of years and traded it well, and I missed this last move up. And I'm not going to chase it and go after it like that. EEM did have a DeMark exhaustion sell count on 13 as I look on one of my screens up there on my DeMark screening service. But that I think it's, look, if the U.S. catches cold, which I think is very possible, I think everything's going to get hit a bit. I'm short FEZ, the Euro Stocks 50. My good friend LaShrub, and I talk about that one a lot. And but I think Europe's kind of gone sideways. It hasn't made a new high since February.
Mm-hmm. Good point. Good point for all the talk we had about that. Tommy, it's always so great to catch up with you. We love seeing you. And I love that you continue to talk about Tesla, even though you get a lot of heat for it. We need that kind of sort of honesty.
Again, hey, they're gonna have a good quarter. This quarter is going to be good because all the subsidies are ending. Their robo-taxis kind of a ride-hailing service, not necessarily autonomous. I know it's not coming soon, as some people will debate with me. That's fine. But next quarter and fourth quarter is going to be tough because there's a lot of pull forward, and that is the risk. So I have a measured position in it on the short side. I'm underwater on it on this trade. But I had a couple good trades earlier in the year with this one. So
Paul just said, Tommy, let me know when you want to sell your Tesla. And by honesty, by the way, I just meant somebody who's willing to take a position and explain why and have a dialogue about it. That's what I mean by honesty. Not either side. But I think that's really important. And we don't have enough of that. We just have people screaming at each other. Tommy, thank you so much. Give us a little recommendation as we sign off. What is giving you a little bit of joy or comfort in your life right now?
A little joy. I live I live in Connecticut. If I look out my window here, I'm looking at a lighthouse. I moved my office from Greenwich to now Rowayton, and I love the simplicity of it. I have a dog that hangs out with me. He's behind me. You might have heard him snore a little during this.
Snoring at your excellent market analysis. I refuse to believe that.
And I just try to take it easy. I work so hard. I'm always online, and I have people in our Slack channel always hey, what's going on? It's a hard business, and taking time for yourself is really important. And my drink, we talked about this earlier. It's not super fancy, but the Spindrift Mojito. If you like mojitos, this is nice and refreshing, and it's got lime and mint. Quite good. I highly recommend it. You can add alcohol to it and make it a full mojito, which is nice. I do like a mojito, but it's nice during the day. And I give up
during the week when we're all trying to work hard and maybe behave ourselves and focus. That's awesome.
I don't drink during the week because I'm up late and researching and reading and reading books and doing stuff that I don't want to be falling asleep in a book or falling behind in my work. So it's
absolutely. I love it. We need some of those recommendations. We need some of those non-alcoholic recommendations as well. So we appreciate it.
Water is good too.
Well, it's not as fun.
I drink a lot of sparkling water, so I will
too,
say
but
that.
sometimes you need something else, and it's not something that's not tea and coffee. So I appreciate that. I'm going to check it out. Thank you so much. And thanks to all of you who are weighing in on how you play Nat Gas in the chats too.
Maggie,
David is a big Mojito fan as well.
I'll respond to a few people in the comment section if they have any questions or any complaints or I always love doing that, and I try to keep it humorous.
As long as you're polite and considerate.
Yeah, I can handle a little heat here and there, but
we know you can, Tommy. That's why we love you.
I try to keep it funny. Look, it's just money.
Exactly. Actually, I just saw a really good clip on money. I'll try to share it with all of you in our notes on Substack. If you are not subscribed to the Market House on Substack, please do that because we're posting some stuff there. It's not making it to YouTube, but we were so happy you were all able to join us today, and so fun to catch up with you, Tommy. So thank you so much.
All right. See ya.
Take care and good luck out there, everybody.